So welcome to Building Wealth Through U.S. Real Estate. Just before we start it, just to let you guys know, I am recording the session and also a disclaimer that all the information we'll be providing tonight is just for educational purposes. Please verify with a lawyer or an accountant. So a little bit about me, if you guys don't know me. My name is Metsa Nakai. I'm a full-time real estate investor. I'm the managing partner of Mada Partners and the founder of Mada Capital. So essentially, we invest in U.S. real estate. We have a real estate fund that uses registered funds to do some land redevelopment in the U.S. And basically, part of the webinar is just to, introduce Canadians to investing in real estate, especially south of the border. There's a lot of things that are happening, and I encourage people to use the chat box. If you have any questions, I'll answer them, and we'll answer some. We'll have it open up. We'll open it up at the end for some questions for Glen. So I'll introduce you guys to Glen. I've known Glen for a few years now. Yep. And we've talked quite a bit about real estate, and he has a little bit of a different strategy, different approach than I do. And I thought his approach is a fun little approach, and I just wanted Glen to share it with everybody. And also, he's got a great little podcast, a Canadian investing in U.S. real estate. So let's let Glen start here.
All right. And also, I don't think it's came out yet, but Matthew and I have a podcast literally on his capital fund and how he works with being able to take Canadian registered funds, which is pretty cool. I don't know if I didn't even look it up, but it'll probably come out in a week or two anyway. But anyway, watch for that one because it's going to be good. This is a little interesting because I feel like I'm talking to myself, but maybe I'll look at the box of Matthew so I don't feel like I'm talking to myself. Here, maybe I'll do a screen share and we'll get into this. And like I said, I don't mind getting cut off. So if you do send some messages, Matthew, just flag me down or just cut me off, and let's answer some questions. Let's go deeper into some of these topics. Some of the stuff in here I'm going to kind of skip over as well because I know we're on like a time constraint, or at least a reasonable time constraint. Everyone has things to get to, so let's not to waste too much time on any of this stuff. Okay. Anyway, like Matthew said, I'm the host of Canadian Investing in the U.S. podcast, so iTunes, Stitcher, SoundCloud, Spotify, YouTube, pretty much all the channels out there. If you've seen my other presentation, it has a similar slide to this, but used to have Texas on the back. Right now, there is no Texas. Texas has just been sold. Missouri is probably pretty close to being sold. Probably by the end of the year, I'll have no more Missouri. But it's always an in and out sort of relationship. I go into markets, I go out of markets. I like markets, I don't like markets. I come back and forth. But that's always sort of changing and for different reasons all the time. I currently own properties in both countries. That is true right now, but I think by July, besides my primary residence, I'm selling off the final bits of my Canadian real estate because, as everyone who lives in Ontario knows, it is nutty right now, and I'm going to cash out. So some stuff I want to cover in this is buying out of state and country, picking markets, turnkey. I'm almost thinking I'm going to skip over turnkey to get through this. Property management, might touch on that a little bit. I'll do contractors, financing, BRRRRs, flips, DIY, some deals. And still, even for the deals, I'm going to kind of go through that probably pretty quick. For most of you guys know my story. I am a Canadian real estate investor. I didn't start with going right into the U.S. Mind you, you totally could. It's not much different than doing it in your own backyard. Just a lot of times I don't see my real estate. So I guess that could have its advantages and disadvantages, and more of how comfortable you are with it. But honestly, I think you could jump right into it. I used to do flipping, and I had a bunch of rental properties, a bunch of duplexes in Kitchener-Waterloo, Cambridge, and Strathroy in the area. But like I mentioned, those are almost all gone. Onto the last ones now. And I'm trying to fly through this. So like I said, slow me down. what does my business look like now? Well, these days, I was, well, if you talk to me in 2020, I was in love with joint ventures and I was doing a ton of joint ventures. I'm doing a lot more of private money now, taking private money and stuff, and I'm sticking to my joint ventures that I know and love and we've had a good relationship with. And I'm taking on a lot fewer joint ventures, which some people might say is a lot like career suicide, but it's all about managing your time, and there's advantages and disadvantages to every strategy. But what we do now is I buy a lot of properties, we renovate them, we refinance them and keep them. Usually if they're a single family home, we've turned it into a lease option. If it's a multifamily, then we rent it regularly. And then we've been doing some flips too. So we've been flipping on the outskirts of Dayton, Ohio and Northern Florida. Some of these big cues that I'm hoping that I can try and answer for you is, can Canadians get lending in the States? And obviously it's yes. Maybe I'll try to, when I get down to the lending part of this, I'll try to go a little bit deeper into that, like talk about some of the lenders, talk about where you find them, what you're doing. Will I get taxed in both countries? I'm going to leave that one all over to Elliot. I can cover that, but you know what? Literally what I'm repeating is stuff I've learned from Elliot or Ali, the two CPAs I always have on my show that are both amazing. But I have Elliot here, so I'm not even going to touch that stuff. And how I buy stuff that I've never seen. Like literally, it used to be that a little bit of my portfolio, I'd never seen it, but it's getting to be a large part of my portfolio that I've never seen, and just being comfortable with that and some things you can do to try to make it safer for yourself, because it's easy to get ripped off on all this stuff. This is from my episode 100. So I stole some slides from there. So I know that a lot of you have listened to episode 100 or episode 1 of the show. So we don't really need to go into it. So I'm going to go point form, quick bang through this stuff, because I think where the real meat and is going to get from the questions, and then I can go deeper into whatever you guys are interested in. But why people do this, obviously low property taxes, low entry costs. I'll show you some of my properties. They're not even the most recent ones, but you can buy stuff for phenomenally cheaper prices, and landlord laws. So there's no, like, for instance, with these landlord laws, I know the Ontario landlord, what do they call themselves now? I haven't even done this in a while. But if you're going to the tribunal in order to do these evictions, it's way behind. And I know that the Americans were behind before, but the evictions are back on. A lot of things have returned to normal in the United States. They don't have a lockdown like we have right now for us here. I think Ontario, I don't know, does Quebec have it right now, Matthew? I know BC does. Is it the whole country, or I don't know. I know that at least a couple of our provinces are in lockdown. I'm so out of touch with the news right now.
Yeah, Quebec's got it.
Yeah, the Quebec's got it too. Yeah. But I know you're in Ottawa, so I knew you were close. But the backups aren't like they have now. The eviction process can be much quicker. Sometimes when COVID's not on, because I know COVID screws up everything, but you can get evictions done very quickly, usually in a month. Is sort of the going rate, sometimes even quicker. And one of the big differences is for some of these contract states is with contract states, like it's not thought of the same way as we think of tenancy here locally. It's a contract. And if you don't pay your contract, you're still legally liable. So I know for properties I've had in Missouri or in Indiana, whenever you go to do an eviction, the attorney will ask you afterwards if you want to put a lien on the person, or you want to go after the person personally to continue the collection process. So theoretically, as long as they are getting like money through the regular chains and they're not working under the table, you should be able to collect your money eventually, even for if you get the worst tenant that you've ever dealt with. The thing is, with all of this, it's all state specific. So some states are going to be worse than where you live right now, and some states are going to be better. So I'll touch on that in a little bit. but it's about doing even some slight research. You can Google if your state is tenant friendly or landlord friendly, and they will literally tell you. There's not, it's pretty open for a lot of these things. And the one thing I don't talk about enough is the downsides of doing this American real estate. I always paint this nice glossy picture of how everything works so smoothly, but financing is a big one, right? And it's not even like, sometimes it takes longer to get your financing than you're expecting, right? The financing can be brutal for timelines. The financing can be difficult for the interest rates are higher. Even if you get in with Royal Bank or TD or BMO Harris or Desjardins or National or one of those other Canadian banks that are down there, literally their interest rates, even though it's still a Canadian bank, are still going to be much higher than in Canada. You're probably talking in the threes somewhere. Whereas if you're doing like the hard money route or the more almost like commercial type lending, you're going to be in the mid fives. But that still isn't even a hard thing, because you get into some mixed use buildings, which I'm dealing with now, and the rates even go up into the eights because they're harder to finance. Some of the financing stuff, I did want to get to this later, so I'm going to kind of jump around all over the place. But with financing right now, we're finding the leverage rates are going up. The loan I just did last week, I got 75% loan to value for the first time ever. And I was literally listening to, because I keep record a lot of my mastermind groups and stuff. And I was talking with my group this exact week last year. So I was just doing a 1 year refresher. And 1 year last week, we're all sitting there, and it was sitting around in a circle going, can anyone find financing for a foreign national? And that's just 1 year, because that was COVID, early COVID, when they were in lockdown. And so financing changes a lot all throughout the year. They change their rules all the time. There's no point in writing down any rates because it changes all the time. It changes much faster than the Canadian interest rates. We kind of keep our rates pretty steady-ish in Canada, and the things change all the time. The loan to values for the foreign national programs, they will change, the rates will change, the terms will change, the points will change, the loan origination fees will change. And just to go into that, what some of those things are is a loan origination fee is the part that the lender takes, right? So the lender takes a cut. A lot of them, well, the one I just did was $1,700 for a loan origination fee. Often it's $2,500 is what the lender wants as like the setup fee. Points are on top of that. And the points is what the mortgage broker is getting. And if you think by going around the broker and going directly to the lender, you can get rid of the points, that's not the case. They will still charge you the points. Just somebody internally is taking those points. Anyway, get through this. Financing more expensive. Tax returns. You need to do your taxes right. Elliot will tackle this, right? It's all about setting up proper corporate structures. There's structures that work better for Canadians. There's ones that don't work well for Canadians. Not going to go into that too deep. Cash is king. And that's always a slogan that people say, but like, what does it really mean? And what it's talking about often is with wholesalers. And the thing is, why the wholesaler can get these properties usually at a discount is that the seller has some sort of urgency. And for them to roll this whole deal and complete the transaction on time, they usually have given a window to the seller of 2 or 3 weeks. So they need like a week sometimes to market this property and find the seller. And then there's only 2 weeks left to close this property. And what happens is, why cash is king is a lot of these loan programs, they can't close in 2 weeks. So if you want to work with these wholesalers that work really fast, you're going to need to be working at their speed, which is cash, right? Sometimes if you have the 2 week window, like some of the best deals are ones that they have 2 days to close because there's an urgency, right? But even if you have 2 weeks to close, that could be enough time for hard money to catch up. But don't be going to the hard money lender and going, oh, I have this deal I want to close in 2 weeks. Can we start the paperwork? you want to be like kind of working with someone ahead of time. If you're going to try and do that technique, you want to have all the paperwork filed, and it's going to be like, what do we need to close? They're going to ask for anything new bank statements, but you should have that all up to date with them anyway. But they're going to want the details of the deal just to close it really quick. Like that's all that they should be dealing with. And then you can go through with closing this quickly. Short sales, foreclosures. A short sale is where the bank is willing to sell it at a discount or at a loss. So they're selling the property for less than what is owed on the mortgage. It's a little bit less common. In all honesty, it's a very difficult process to go through. I put offers on them all the time. I have one right up here right now that I have an offer on. And what happens in most cases is nothing happens from it. You put your offer in and nothing happens. And because what happens is you need to first make a deal with the owner of the property to agree on a price, and then the bank has to agree to it. And even if you got that property under contract with the seller, the bank just drags their feet. I've actually only ever got one to close. I've put offers on probably like 20 of them. And the one that I did get to close, from starting the process and to finishing it, was about 8 months. And that was for still buying it with cash. There was no loans that I was putting on to do anything. And I was just ready for whenever the bank finally said that they were ready to go, because there's a lot of paperwork to go through. Right now, one of the things that's really brutal in the States is permits. It's one thing that's really screwing up my renovations is taking, they're not in lockdown, but the government is still not often working at their offices, at least at the same capacity as they were. Sometimes it's like half staff or third of their staff, and they're rotating through. So they're finding getting your permits can take longer than it used to. Getting inspections for your electrical, your plumbing, that stuff is taking much longer than it used to. So it's one of those things to keep in mind. It doesn't really fall into this barriers or downside. I added that just this morning, but it's one of those things. A lot of people are using loans like a fix and flip loan or a fix to rent loan or one of those loan programs, and build yourself in a lot of extra time for doing these properties, right? Because you might you might be surprised, because just your things can easily fall behind, and it's not anything that your contractors did. I know I'm getting kind of into the
Glenn,
nitty-gritty. Yeah.
I'm going to interrupt you. Patrick
Yeah,
wrote a good question there since you're talking about the downside. He said, wow, this downside is really informative. I haven't heard anyone talk about this before, given all these downsides, and investing in the U.S. worth giving the crazy capital gains in Vancouver or Toronto over the last decade. I'm thinking about investing, renting out a vacation home. Is that a bad idea? Should it be seen mostly just as an investment? Like some of the stuff you're saying, I can relate. We had a property that it literally took us 5 weeks to get the connection to the gas company, just because they're so backed up. It's not like in Canada, you can get somebody with their license that can connect them from the meter into the house. This is a whole different ball game. And we lost around 3 weeks because we needed to list the property. We couldn't list the property without even having a gas connection to the appliances and everything.
Yeah, I've had the same thing. I've had sometimes where the meters no one's been living at this house. The gas has been turned off, or the electric has been turned off for maybe years. And they require you to actually change the box on the side of the house. And it's just like extra stuff and an extra person to come in from the city. Sometimes, depending on the state, sometimes your contractor installs it. Sometimes the city installs it, or not the state, the county installs it. Or the electric company, and it's always a little bit different. But yeah, it can really throw off your timelines. What was he saying? He was wondering about if it makes sense to do short-term rentals.
Yeah, basically investing in a vacation home. Is it a bad idea?
Well, I don't know. It could be a great idea. There's people that's my guest 2 weeks ago, Carmen. She's like buying in Fort Myers, Florida, and she's buying like $1 million homes and renting them out for $20,000 a week. So like right there, you could easily be retired, right? And you go $1 million home, if you're in Florida, you could go get a mortgage with, say, RBC or one of the Canadian banks, even, because they all operate in Florida, and boom, 20% down and tons of cash flow. Like like, honestly, I don't, it's to say that a strategy doesn't work. I'm going to say certain strategies do work better in certain places, right? Like Airbnb works everywhere, right? Airbnb works in, like, as long as you're permitted to do it and they don't change the laws on you, like, it works in really expensive markets, right? That's one of the only ways you make it work in really expensive markets. Like, a lot of times, a long-term rental won't work in a really expensive market, or it won't cash flow much at all. Then it's not even worth your time, at least in my, not worth my time anyway. So yeah, then you're just playing the appreciation game, and obviously it's not the game I play. If you were into the appreciation game, you do much better doing Canada right now, because Canada's appreciating. The market I live in right now appreciated 35% in 1 year. So you can't beat that, right? So it depends on what is important to you and what your strategies are. But Airbnb, that strategy works in cheap markets, it works in expensive markets. I have one in Dayton, Ohio, an Airbnb. That's a cheap market, right? And it works there. We're completely sold out. And if you did it in, like, you know, Miami Beach or South Beach or something, or you did it in Vancouver or Toronto, it works in all those markets, right? I think you could do it anywhere. So
And Patrick, another thing too, like I've been looking at buying something in Florida, and we kind of want to do like a theme house Airbnb. You know, if your acquisitions cost around 330 to 380 for something nice, a 5 to 6 bedroom with a pool, hot tub in the backyard, in a gated community where there's like a lazy pool, a restaurant, and so forth. You put a little bit of money in renovation, you can definitely get some crazy numbers. I've seen people get on average 450, 650 a night, depending on the product they're doing on a theme house. So some of the properties we're looking at doing are going to generate around $125,000 to $150,000 a year in income on the conservative side of things. So, you know, it depends of what kind of cash flow you're looking, what kind of investment you're doing. And if you're looking at, there's a question there about TD and RBC. So I've been in discussion with RBC in the last couple of weeks. The problem that I'm having with RBC is that they're going to lend on the lower amount for a situation like this. So if you pay 330 and you're upgrading the property, but it's worth more, they're only going to give you the lower amount. And they haven't gone back to me if they would be okay if I renegotiated the mortgage after it's stabilized. I'm still waiting from that. But believe it or not, RBC's got only 11 people in their department representing Canada for secondary homes. So they'll lend in every single state, which is amazing. But there's a little bit more strings to pull to make it worth the investment, I find, using RBC. TD, I'm still waiting to get a good TD person to talk to, but it's roughly the same as RBC from what I understand so far.
yeah, the main difference I've found is just TD isn't in every state. They're only up the East Coast. It has to be basically the general rule. I think there's probably a couple states that don't follow it, but it has to be touching water on the East Coast. That's all they do. They don't even do Georgia. They don't do anything that's even slightly inland, right up the coast, which for me, that means really the only state that I invest in that they would even lend in would be Florida, right? And Florida has tons of options. Like, that's one of the, you know, that's not saying that to go there or not to go to Florida, but for Canadian lending from Canadian banks, Florida has the most options. But you know, there is tons of other options. So there's hard money, there's other things, and there's, even though you might have a higher interest rate or even a lower loan to value by using some of the other type of lenders, you're gonna the numbers can be much better in different states, right? You could be the same house sitting in Florida could be worth like 150,000. In Ohio, it could be worth 60,000, and the $60,000 one rents for like 1,200 a month, and the one in Florida rents for 1,200 a month. And so it's a up and down balance game. So you have to basically run the whole thing through to try and find something that works for you, right? So the interest rates will be lower. The Canadian banks are going to qualify you on your Canadian credit scores, though. So Canadian credit scores, Canadian debt service ratio, your Canadian what do they call it? Your leverage, like what you've got on there. So it's going to be all on your Canadian stuff. Whereas if you go to some of the American ones, sometimes they'll take your Canadian credit score. It doesn't really help or hurt you, but a lot of times they're basing it on what you're buying. If it's how well does this property perform, rather than how much money you make at your 9-to-5 job. It's more important about what this place is going to rent for, what it is rented for, and what the actual numbers are, which is more like commercial lending. If you're going to go buy a multifamily building, that's how they're going to run the numbers. They're going to base on a cap rate and what the net income of the property is to figure out the value. That's more how they're going to look at even a residential property, based on the same kind of thing, but not cap rate. Anyway, way off topic, but I think it was good. So lots of different ways to pick your market. I think the main thing, I think everyone had time to look at this. The main thing to look at is that crime rates are declining. So you can still buy in areas that have crime. One of the websites I like to use is Neighborhood Scout. I use that. There is the free version. It takes a little bit more work to work with the free version, because you're going to have to the way I do it is I put like a map of like Google Maps up with where the pinpoint is, and then I put it up the Neighborhood Scout, and I try to like figure out exactly where it is. Whereas if you pay for the paid version of it, you can just type the address and it'll tell you right in. It'll give you the neighborhood stats, and it makes it a lot easier. And I've had trials of it. I've never actually paid for it full time, but they do send out trials every once in a while, so you can go in there. But you can still fully use it and check out the crime rates, check out the appreciation rates of different neighborhoods for free. But it's just a little bit more work on your own part to do this. And another thing is to check for businesses employ your tenants, the 20% rule. You don't want one company to be more than 20% of the employer, employing more than 20% of the people in that town, because that's a one-horse town. A lot of people follow around like Amazon and certain businesses, but sometimes Amazon's the only thing there, and Amazon will move, right? Amazon will go to the place that is going to give them the best tax breaks and the free land, and they will move. They'll literally pick up the whole warehouse and move it to another state just for a deal. So if you're strictly buying on that, it might not be the way to go, because it might be a great rental market for like 10 years, and then it might just pick up and move on you. So you want to have other stuff there. Ideally, you'd like to see like, some medical facilities or something else that's employing a whole lot of other people. And that's the problem when you get into some of the really small towns, is there is only one thing there. But usually when I'm investing in the small towns, I like them to be like close enough to a city so that they can, they can commute if they need to, or they have people who are commuting. And also, try to get properties buy properties in towns that are at least 100,000 people that live there. And the reason is, I bought a property where it was lower than that. And just being a Canadian, there's like 10 million lenders in the United States. And then just being a Canadian, we're down to like 150, right? And then out of those 150, there's probably a whole pile of them that won't lend unless the population is 150,000 or 100,000 people. And it's just like, I still got the loan on it, but it just makes your life more difficult. And the purpose of going to the States is to try to make things easier and more profitable. So there's huge advantages. I've had a bunch of people on my podcast who invest in little towns, but sometimes you're just going to have a harder time for lending. And sometimes you might be just dealing in cash, depending on how cheap they are. Speaking of lending, since I'm going on this lending rant, the other thing to think about, I lost my train of thought, but loan to values, you know what, it'll come back to me. Anyway, for picking your states, I really need a new picture for this.
I'm going to stop you. There's a question here we can talk about. I thought the taxes are much higher, like $10K for a $400K house in Texas, which states have $1,000 taxes. So I know me and you kind of have a different strategy when we're investing in real estate. Like, I invest in properties that have, tax abatements on on the redevelopment side. So, I might buy a piece of land for 100 grand, put in $400,000 to $500,000 of new construction on it, and only pay $1,400 of taxes a year on that land, not the value of the building for the next 10 years. So there's different ways. I know Glenn does it a little bit differently than I do, and I'll let him explain it also.
We've done some of them where we buy properties with back taxes on them, right? Sometimes you can get big deals because the banks won't finance that part, right? So a lot of people walk away from those things with properties that have, $15,000 or $20,000 back taxes. And it depends what your strategy is with that property. Sometimes you just pay it off in closing and just go ahead like you normally would. And sometimes depending on how it works, sometimes you can negotiate that with the state or the county. And you could make it so you could take that $10,000 or $15,000 bill and spread it out interest-free, and just to get it caught up for 5 years, right? And break the payments down so that you don't actually have to come up with that money. And it's almost like an interest-free loan, right? So you could, if you think about opportunity costs, instead of putting your money into paying off those back taxes, you could put your money into something else, right? So you could, it's almost like getting interest-free loan, like I said. What was the question that they had? Did we even answer it?
I thought the taxes are much higher, like $10K for a $400K house in Texas. Which states have $1,000 taxes? It all depends of where you're investing.
Yeah.
At the end of the day.
So I think the way to do it, because I'll be honest, I haven't analyzed every state. Alabama, I know they have cheap taxes. Ohio has pretty cheap taxes. The other thing I just think talking about taxes is one thing we always forget about is what do they call that? If you don't live in the house, they have there's a word for it anyway. Homesteading. So if you don't have the homesteading credit, in some states, they double your taxes. They will so if your taxes are normally $500, they'll be $1,000. So it's one thing to figure out if it's a state that does homesteading or not, because when you're running your numbers, if you go to, I don't know what you like to use, like REI Pro or Privy or PropStream or wherever you like to pull your numbers from, and you go and pull, or even the tax records right from that county, and you see the tax number and you plug that into your thing, sometimes it's going to be double that because you aren't homesteading it. If someone was homesteading it, and it's all about how diligent the state is too. So I think some of the states where I might not be paying the homesteading credit, they just haven't checked. It might just show up at some point that my taxes double because I don't live there. I don't live in the house, right? So they basically give you, I don't know if they consider it a discount for living in the house or they just make it a penalty for renting it out. But anyway, something to think about. Anyway, this is a quick map. It's really brutally made. I did this a long time ago. I've really been using the same one. That should be my 2021 goal, is to get a new map. But it gives you some ideas about landlord friendly and tenant friendly. I know New York is really popular, and I put New York in red. But New York is I think it's the only state in the entire U.S. that does their landlord tenant laws are county to county. So some counties are okay. Some counties are really bad. New York is really bad. But there are parts of upstate that are good. But as a blanket statement, I usually just stay away just because I don't know. But you do a little bit of research and you can make it work. I think a lot of people are attracted to upstate New York just because it's close, depending where they live. But you know what? People do great things in any state. So I'm not completely poo-pooing on New York. But yeah, just be careful if you're going to New York. Look at your laws. Even try to do maybe some simple Googling, whatever county landlord eviction laws, and see how they kind of play out whenever they do them. Like what kind of timelines, who usually it favors for the judgments. So you can find your deals all over the place: MLS, pocket listings, turnkey, wholesaler, from a bank, tax deed, FSBO. Where do I find my deals? Literally, I'd say 90%, maybe even 95% are from wholesalers. And whenever I am working off the MLS, my properties typically are a short sale or a foreclosure. I am getting some new apps to be able to scrape the MLS. So it would basically do like, it would give you some rough ideas, this new app. I'll have a podcast coming out on it late in probably a month or so. But what it does is it basically will, it'll kind of be using like Zillow type numbers. So if you have what Zillow thinks it's worth and what it actually is worth, but it's still Zillow, so it's kind of not that accurate. But it'll basically scrape quick, and you can get your quick answers to make a list of stuff that's on the MLS. So you're not just, because there's too much out there. There's too many properties to go through the whole thing, right, for a whole city. So it'll just scrape it down and make it a lot short. I'll make a short list for you, and then be able to compare some properties for you. Yeah, that's where I am. I started off buying turnkey properties in the States. They do work really well for some people. People don't have a lot of time, people who want to set up a team off the start. But anyway, it has its ups and downs. You'll make more money doing it yourself than doing a turnkey operator. Basically, the turnkey operators are flippers, but they're just flipping it. They don't have to do it to a retail quality because they're doing it for tenants. So they don't renovate to the same standard as a flip. It's not the same as in Canada. You see the rental properties here locally, and they're very nice. Sometimes the turnkey ones could not be at the same level. They're going to have the laminate countertops often, and just not to the same specs. So when you're pulling your comps on those, just keep an eye on that. I'd also want to see like some of their other projects to see how to, to compare apples to apples, because especially if you don't see the renovation, how it's going to go until you're already buying it. And you pull comps and you're like, yeah, this house should comp out against this other house, but then they haven't done the same finishes. It won't comp out, and you might be upside down when you buy it. So just be careful. But that's the same thing with buying the MLS. Comp your stuff out properly. Getting property management. This is like one of the key cornerstones to setting up your teams down in the States. The best way to get your property management, I found, is word of mouth. It's not going on to Craigslist. It's not Googling property management in Kentucky. It's finding people who are already working in those markets and who they use. People are often open to sharing their property manager. Because a property manager can handle a large amount of people. If you're talking about, say, like a contractor, some people might not be willing to share their contractor, because contractors have a finite amount of jobs they can do. Like depending on the level and how many people work there, they might only be able to do like 4 jobs at a time, or 1 job at a time, or 10 jobs. And if they're really good, a lot of people won't share them because they want to use them over and over and over and over, right? So, but for property management, that's not the case. The people will share those because it's not going to hurt their own business, right? Recommendations, depending where they are, that's bigger pockets. If you put a post on, say, like a Facebook group in like Kansas City, for instance, real estate group, and say, hey, I'm looking for a property management. Look at the people who are recommending property managements. Make sure they don't work for that property management company, because that's not a recommendation. That's an advertisement. So you want to sort through them, find ones that are actually people, and actually go and have a conversation with those people. If they're open enough to say, hey, I recommend Bob and Joe's property management, you should like ask them about it. And the thing is that I'm always looking for in property management, when you're asking people about it, have you had anything bad happen? And then how did they deal with it? Because property management that have had a property that runs perfectly smooth and they just collected rent, that doesn't mean they're good or bad, because you don't even know. They haven't been tested, right? You want people who are good with dealing with problems, because that's when you need them. Whenever things are bad is when property management is going to save your life. When things are good, who cares, right? You could be doing it, managing yourself from Canada. Who cares, right? But anyway, sometimes the property managers are provided by the turnkey operator. If you're doing turnkey. So that's one of the advantages of turnkey. They kind of set you up with some sort of teams. Contractors, same thing, word of mouth. I kind of covered that. Pay for connections. So that is one thing that I've kind of been humming and hawing about. I did pay for some connections about a year and a half or 2 years ago. It turned out like I got a list of contractors which was supposed to be good. The 5 contractors I was provided, 4 of them were complete garbage, and 1 of them was really good. So it's still, that's the hard part if you're starting or changing markets, is contractors. I almost suggest, if you're going to work with contractors off the start, would to put a loan on the property. And that sounds backwards intuitive if you have the money, I guess, or maybe it doesn't because you're leveraging better. The thing is, if you're doing a fix and flip loan, and you're working with a new contractor, it will force the lender will not release money until their work is inspected and approved. So you now have somebody else who's checking that contractor. So it's a good little tip. So the way the process would go is you would buy a property with the loan, and the contractor would go do like his $5,000 of work, and he'd say, oh, I did the plumbing and I drywalled this wall and I did this. So on the draw sheet, check, check, check. This is what's all done. Pay me for this. And you let them know that this is how it's going to work with a fix and flip. You're doing a fix and flip loan, so they know how they're going to be paid, but they're going to get small chunks. Also, don't give them a big chunk off the start, but this way they get little chunks. And so then you pay an inspector, which is usually about $100. They come in, they check over all the work, and they will pay you for what is done. And oftentimes, it's less than what the contractor says is done, because the contractor will say, sometimes it's just certain things. Keeps everybody honest, especially for the start. It's a good way to keep everyone saying what they're doing. I know we're running out of time, so I'm going to fly through this. Skip turnkey, skip turnkey, skip turnkey. Everybody knows if you do it yourself, you're going to make more money. You're going to have to pay a couple extra things. Not a big deal. You'll pay for the lease up fees and stuff. But that's just part of doing real estate, right? You have to find all the team yourself. But you have way more options, right? You can get creative, way more creative. You could do seller financing, BRRRRs, flips, lease options, subject to, all kinds of stuff. There's more options for you instead of being into one little box. Better purchase prices, working through everything. I think I covered a lot of this stuff already. Lending for foreign nationals, some of the current trends, some of the values, the loan to values are going way up. So if you would have talked to me even a couple months ago, 65% loan to value was like that's basically all you're getting. Sometimes they'd lie and say 70%, or they tell you 70, and they honestly thought 70, but you get to like a couple days before the closing table, and they'd switch it back to 65, and you'd be like, I took your loan over the other one, even though yours was more expensive because I had the higher leverage. So that used to be the thing. That used to be the trend. I used to get I call it the bait and switch. I used to get it all the time. But now I literally just got a 75% loan to value. So they're out there now, and that's a cash out refi at 75%, not to be confused with a purchase at 75, because that you could do that before. It's when you're trying to extract all the money out of the property is where the loans it's almost, they're different programs altogether. A refinance, a cash out refi, a purchase, completely different programs, completely different rates. So if you're just calling around and asking people what their rates are, a lot of times they're going to give you the purchase rates. And the purchase points. The other ones are going to be different and have different criteria and different qualifying for them. So a lot of times, if you're going to rip all the cash out, they want to see you have experience, right? Because you have nothing on the table. If you do a perfect BRRRR and pull all your money out, like what's causing you to just walk away when things don't go good, right? Say the market crashes. They don't want people walking away. They want you to have some sort of skin in the game. So they don't want you to see some sort of history, want to see other properties, to see that you're not just going to walk away from the United States, right? They want to see that it's going to work out. Loan origination fees have been going down. Points have been staying fairly steady around 2. I found for some of the multifamilies and like mixed use stuff, points are like 3 or 4. Timelines for closing these things are longer because appraisers are so slow. Lenders are so slow, unless there's some sort of like fire under their belt, like to actually have it done, like it's a fix and flip loan and there's a closing date. They still don't show up to closing days often. I've had to double close several times. Just be careful. Have some backup cash, but you should always have backup cash because with anything, you're doing a renovation, things go out of whack, things get more expensive than you're planning to. Notary service right now, COVID. So a lot of times, this is the big one. This should have been the whole week. I could have done the whole podcast. Whoops. Just went back. It doesn't matter. Anyway, notary service. I used to be able to just use, I go to the States, drive down to Buffalo, get my stuff signed, right? No biggie deal. I'm going to go back. Where's the back? But anyway, you used to be able to go down there, or I go to my accountant in Dearborn, Michigan, or I go, there's lots of notaries. You could do a modal notary. I used to meet them at McDonald's right in Niagara Falls, just across the border. There's a McDonald's there. I used to make notary there all the time. I've signed notary on the hoods of cars. All that stuff doesn't work when you can't cross the border, right? So what's across on this side of the border? There's the U.S. consulate in everywhere. I think there's 6 of them in Canada. Guess what? Notary service is closed for COVID. So that is off the table too. So I then went and Googled, what are my options for notary service? And one of the services are, you can go to a regular notary and then you have to get your documents verified. So they send them over to Ottawa and there's a company there and they charge you about $200. No, $400 for each verification of documents. Then you can send that. What really happens if you just don't tell them that option exists, guess what? If you fight with them a little bit, your title company and the lenders, they will allow a Canadian notary. Just fight for it. It's not fun, but they will do it. I've turned people's minds around many times who say it's not possible. You have to have an American notary. You don't. Mostly, especially, you might have to just go to an attorney rather than a notary service, or not attorney, a lawyer in Canada. Go to your regular lawyer that you bought your Canadian properties with and use them, and they will get it done. Seller financing, gold, that's one of the ways you can get in with like anything you want, based on whatever you're looking for, and people are very open to it. I've done many seller finance deals. Sellers are open to it. People think they're afraid to ask. They think the market's too hot. Maybe you can offer them like their full asking price instead of like the 10,000 under or whatever, depending what market you're in. And you go, why would you do that? Well, maybe I could do interest only or principal only and make the whole deal work because it's actually cheaper every month to pay them $10,000 extra. And they're willing to do it because they're going to make $10,000 extra, and you've got no interest for the loan, even if it's only for a short loan. And even when people will go, why would you do that? Because setup fees for these fix and flip loans can be like $5 or $6 grand. So you're just saved yourself $5 or $6 grand by doing some of these techniques. And it's a trade-off. You actually have to look at real numbers to make it work. Financing cheap properties, my one little tip, check the HUD statement whenever you're buying it. And that's state specific. In Alabama, they show you the seller side and the buyer side. So you can see who is the mortgage on this little cheap property you're buying. And you can just ask the bank to be your lender too. Boom, you got lending. You found someone who will lend on really cheap stuff. But that doesn't always work. In Ohio and in Florida, they do not show both sides. They only show your side. And then they put totals at the very bottom, so it doesn't show all their information. So there's different privacy for different states. Corporate structure, that's Elliott. Double tax, Elliott. Withholding tax, I don't know if Elliott knows much about that. I just paid my first withholding tax ever on my tax return for the first time ever. They asked me for withholding tax, and then they said, I don't know if it was because we were filing right at the deadline that they wanted a pile of money, and then they were going to give it back to me afterwards. But anyway, maybe Ali will know better than that. If you've watched my podcast, some of these properties I've shown before, these aren't new. This one I bought I think 3 years ago, but it returns crazy numbers, right? So you can get some stuff. This one was actually off the MLS. This is, I think, the only property I've actually bought off the MLS. So that was there. It was a nice and good, clean shape. I bought this one as a short sale. no, foreclosure. Short sale. This is the short sale one I bought. So I negotiated with the bank to get this one. And it did really well. I'm actually selling this one. So see, I put down here, selling for 200K this summer. So I had it, my numbers based on 145, and the renter is going to buy it off me for $200,000. So that just shows you that the American market is taking off just like the Canadian market. This is one we just finished and are refinancing right now. We bought it for, what did we buy? $17,000. And I think 10,000 of that was back taxes. So it was really $7,000 purchase. But anyway, there's lots of money to be made if you find good deals. And a lot of it is putting the time in and looking through a lot of properties in order to do that. This is, I think, my last slide. But what happens if there's another crash? Everyone's like 2009. Honestly, I think that 2009 thing is more likely to happen in Canada right now. If we're getting 20 to 30% appreciation year over year, there's a problem. That's how 2009 went into in the States. Crazy appreciation before it dropped. I'm terrified if Ontario dropped to even last year's prices, we'd be in a lot of trouble. But anyway, it could happen anywhere. Both sides of the border are on a big upswing right now. But the people who lost their houses, the ones who didn't have CapEx fund, which is money for capital expenditures for roofs. You had a roof go while the property was in COVID or during a crash, you can't get financing. And COVID was a test, kind of like 2009. Financing just dried up. It just disappeared. They had short-term financing that came due. That's a dangerous game to play. A lot of people love this 12-month loans. I still do them for fix and flip loans. But even the 5-year loans, like the typical Canadian loans, if you do those same sort of loans in the States, what happens if the world falls out or another COVID comes through and there's no financing when your 5-year term renews? They're not lending. You're in trouble, right? So I often take a 30-year thing, even for some of my lease options, which is like a rent to owns. They're going to be buying the property in 3 years. A lot of times, if the rate is very close, I'll do a 30-year loan just because if something doesn't go to plan, I have my financing set up for 30 years. I don't have it coming due at a bad time. And I can just dictate when I want to do it, to do the refi or do whatever I want. And it probably didn't cash flow. That's who lost it. But yeah, last slide. You guys know who I am. If I flew through this, if you have questions, if you're interested in coaching, any of that stuff, email me, glenn@glensutherland.com. I'll try to answer them. Please don't send me like 40 paragraphs. I like almost like a text message, like 1 sentence or 2 sentences. I don't want to be doing like a massive email. I love to help people, but let's just work together. Quick chats, almost like a text. Anyway, Matthew, Elliot, take over.
I'll get you to stop sharing your screen there.
Yeah.
Glenn, that was great. I was actually thinking about your short-term rentals, just your client in Fort Myers. I mean, I have a client. He owns 5 properties in Naples, around $500,000-$600,000.
Yeah.
And he does short-term rentals on only, and honestly, he makes hundreds of thousands of dollars every year. Like, he's thinking about moving to Florida just so he can avoid paying the Canadian side of the taxes on that. But yeah, I mean, it can be pretty profitable, especially in today's world where people are kind of looking for more. More seclusion when it comes to properties as opposed to kind of large hotels to vacation in and stuff like that.
Yeah.
So, there is certainly a profit to be made. And if you buy right and you buy with the right people, then, you can do very well. So.
And you kind of touched on one item there. You said like you move into the States to try and avoid it, right? Because what people are always worried about with these taxes is getting a big tax bill from the IRS, when in fact, the more likelihood is you're going to be paying taxes to Canada Revenue, right?
Correct. Exactly. So, I mean, the way it kind of works is that if you buy property, whether it's through your personal name or a partnership or a trust or whatever the case may be, typically, since the property is located within the United States, the U.S. or the IRS in that state department gets first crack at the tax on that property because it's located in their jurisdiction, right?
Yeah. So
you have to file a tax return for in the U.S. and in this case, it will be Florida. There's no state tax there, but as a Canadian, you're taxed on your worldwide income. So you have to report that rental income as well on your Canadian return and pay tax on that. I mean, there are foreign tax credits that can be claimed, But end of the day, you are paying tax on that rental income in Florida at your marginal rates here in Canada. So if you make over $200,000, you're going to be paying 53% tax on that profit every single year, right? So it's, I mean, end of the day, that's kind of the tough part of being Canadian. We do pay for it if you do make if you do have a sizable income, right? So if it's structured properly, we can take advantage of it. But at the end of the day, it's tough to it's tough to navigate U.S. properties if they are pretty profitable, to be honest. So yeah.
Yeah, you just mentioned the right thing there is how it's structured, right? So sometimes, depending on what your goals are, you might want to use a C Corp, sometimes an LP, and very rarely an LLC. But yeah, like in what you were just exactly covering that. It's sometimes you don't want to pay tax on this, or you'd like to pay corporate tax rather than personal tax, and so you just leave it in the corp, right? There's ways to do it, right?
Yep. So it really comes down to what you're looking to do, to be honest. I mean, the first when you're buying these properties, whether it's short-term rentals, long-term rentals, development, whatever the case may be, I mean, it needs to align with your goals and ultimately what you want to do, right? I mean, I have a set line of cash flow that I need to maintain, that I have every year, literally scheduled out for the next 20 years, to maintain, that way when I ultimately do some of my tax business and my other businesses, that way I have the sufficient cash flow to maintain my standard of living in retirement, right? So, and then I can buy properties based on those goals and based on that plan, and then we can structure, from the tax perspective, we can structure it however it works that meets that timeline and those goals. So yeah.
So we have a couple questions here, Glenn and Elliot. So one of them is, which lenders other than TD RBC works with Canadians in the U.S.? In my experience, without U.S. residency, only private lenders may be interested in those charges and arm's length financing. So my model is a little bit different. I use U.S.-based partners to develop our properties, so they'll guarantee the loans for me. Typically speaking, our model is we split the profit 50-50. They do all the work. We put all the money in for the land acquisition and the soft costs, and my partners make sure to deliver on a product, and we're able to refinance it that way. And I find it's been the quickest path for us to grow our business. I know Glenn's a little bit different than me in his business model, and I'll let Glenn answer that question also.
Yeah, so there's all those Canadian banks, right? Besides TD, like RBC Bank, TD Bank. I don't think Scotia has. CIBC has something else down there in a different name. I don't know what their affiliate is. If anyone knows, throw it in the chat. I know they have something that's affiliated down there. Desjardins, some of the French banks. I think Laurentian might. National Bank, they're down there as well. And the real trick, like defining, depending on where you are, like if you go talk to like some of the guys, I've had some mortgage or even real estate brokers or real estate agents on the show, and they will know, especially in Florida, who will lend. Tons of options there. So the rest of the place, like there's still, you can do those Canadian ones, but maybe you don't have, maybe you're maxed out and Canada isn't gonna, these Canadian banks aren't gonna lend to you anymore. You're like, well, where is it? So I don't want to do name drops, I don't think, because if this is being recorded, it changes all the time. I sometimes love lenders and then I hate lenders because they are inconsistent. But one way to find them is look for banks that have foreign national programs. Almost, like I'd say 95% of the banks that are online banks have a foreign national program. That's what we're considered, is foreign nationals. So you can just ask around. You can go into LinkedIn and look for lenders. Like, so you're like, when I was starting in Alabama, I still got my shirt on right now, but you go into like Huntsville, Alabama, Facebook group and go, hey, who's lending here? And boom, 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 foreign national program. Do you have a foreign national program? Do you have a foreign? Yeah, that works for some. And then you can go to LinkedIn, mortgage brokers in Huntsville, Alabama. Boom, 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 boom. Hundreds will show up. Like literally hundreds of them will show up. And just spend some time, even pay for LinkedIn Premium so you can message people, more people. And usually I think they give you a free trial off the start for 30 days. Go through and just ask them, do you have a foreign national program? And you'll find a lot of them If they are a bank you've heard of, they do not have a foreign national program. If it's Chase, Bank of America, the big ones, Wells Fargo, they do not have a foreign national program. It's the little banks that you want to talk to that'll have something for you, or they'll lend to foreign nationals.
And the little banks are really great to deal with because they want the business. And like I was telling Glenn a couple of weeks ago, our bank gives us 2% on our money in the bank. Like,
that's incredible. Like, and I put the name on the podcast. I put that name in the description underneath it because we didn't actually drop the name until after we recorded it. But yeah, so if you like are looking for someone, you know, and a lot of times you don't realize even for these banks, they don't have to be in the same state. My bank, like I have like all my bank accounts at Progress Bank in Huntsville, Alabama, but I have properties or corporations in, you know, Missouri, Indiana, other places, Ohio, Florida. And you know what? You can still have the bank account sitting wherever you want. You can have your bank account in Georgia. You can have your bank account with Matthew's person in Pennsylvania that's getting you 2% on the balances that are sitting there. That's incredible. First of all, that's incredible to be earning 2% on just a balance in a checking account. That's not a savings account. So often you're like, for me, when I'm working with anybody, I always have like a reserve. We want to have a certain amount of money left in the bank account. You're actually earning something on that. I know it's not much, but it's something because mine just sits there and gets nothing. Anyway, what else we got?
We'll do the accounting question here. Keith asked, best corps for Canadians to invest in U.S. and the Caribbean: C Corp, B Corp, create a regular D fund.
Yeah, so I mean, you know, I think Glenn touched on this earlier. To be honest, there's no one set rule, to be honest. I mean, most of my clients do have some type of flow-through entity in the U.S., and that's typically the most advantageous way of holding rental property as a Canadian. You know, C corps, you know, they can come into play in certain aspects at certain times, but you know, they do result in double taxation. Essentially, you know, when you pay tax at the corporate level in the U.S., it's currently 21% federal tax, you know, plus 8 to 10% state tax depending on the state you're in. So you're paying about 30% tax corporately. And then when you take the funds out of the corporation, you're paying tax again individually. So ultimately, you're going to be paying more than 50% tax likely on that income. So depending on your marginal tax brackets here in Canada, personally, you know, some type of flow through entity like an LP or possibly in some cases a trust may be advantageous to you. But that's going to be really dependent on your personal situation and your income level here in Canada, your jobs, your goals, and all that stuff. But typically, I do recommend some type of flow-through entity where there's no corporate tax as opposed to, you know, a C corp. So,
call Elliot and tell him what the numbers, what you're working with, and what your goals are. Mm-hmm. He's going to need to know, like, are you planning to have one property and this is a rental? Are you planning to build an empire? Do you have a lot of tax you're trying to avoid paying? You know, it's going to be what your scenario is. And I've set up many corps, and a lot of them are set up slightly different. Some of them have managing partners, some of them don't. You know, some of them are straight LPs, some of them have all the properties are in LPs below. Sometimes there's a C corp involved, and it's what you're trying to do. So talk to Elliot, talk to a professional who knows cross-border accounting to get the right structure, because it will save you money in the end. You pay the small fee to set up the corporation properly, and yeah, that's enough.
There's a question here that I didn't answer earlier on from Natalie. If you have access to Canadian funds in a HELOC, would that be an option to buy U.S. properties, or are you better to get a U.S. mortgage?
No, absolutely. You use the HELOC if you can. I mean, the interest would be deductible on both sides of the border depending on how you're structured. So I have a number of clients that do that. You know, they take out $500,000 out of equity out of the property, and they go out and buy, $2-3 million of property in the U.S. through an LP or whatever the case may be. So absolutely, if you have a HELOC capability, typically the interest is obviously a lot lower than getting conventional financing in the U.S. So that's obviously a benefit to you. You got to remember there is obviously exchange rate we need to consider. So, you know, your expenses are in Canadian dollars through the interest, and then obviously your revenues in U.S. dollars. So, if the Canadian, you know, if the Canadian currency appreciates significantly over the next couple of years, then certainly it's going to be a negative to you, right? So now your expenses are going up and your revenue, you know, in terms of Canadian dollars are going down. So, but yeah, I mean, at the end of the day, you know, if you have the ability to get a HELOC and use that to invest, then yeah, that's, for most people, it's simply advantageous. And I have a lot of clients that do that as well. So
yeah, I like to do the HELOC, use the HELOC for the, you know, purchase and renovation, and then refinance into something more permanent. So for like in and out money, HELOC money is perfect, right? So you can get your stuff lined up. You could do a quick reno. You could then switch it into something else. It's just, it's a cheaper money, and it's really liquid. You can move it around however you like, whatever you want to do with it.
All right. Well, everybody, thank you so much for joining tonight. If you guys have any questions, feel free to reach out. I'll be sending everybody the recording of the webinar too. So if you guys have any questions, by all means, feel free to reach out to myself, Glenn, or even Elliot. And till next time, I'll be posting something else in the next couple of weeks there for another Meetup webinar.
Thanks, Matt.
sounds good.